Welcome back to Wall Street Podcast. Today, we're diving deep into JP Morgan's latest flows and liquidity report. It just hit the desks July 3rd, 2025. And this isn't just noise. It's a really focused look at two key areas: stablecoins, what's really going on there, and the global bond market's supply-demand picture. Our mission, like always, is to cut through the data fast and pull out the vital insights for you.
Right. Let's start with stablecoins.
Yeah.
JP Morgan has a pretty surprising take, actually. Quite grounded, all the hype. Forecasting growth from, $250 billion now up to $1 or $2 trillion? Well, JP Morgan calls that far too optimistic.
Far too optimistic. Wow. So what are they projecting instead?
Something much more moderate. They're thinking maybe $500 billion by 2028. So growth, yes, but not that explosive jump everyone's been talking about.
Okay. And this part really caught my eye. Why are they skeptical? What's behind that?
It boils down to usage. The report points out that a huge chunk, like 88% of stablecoin demand, isn't for everyday payments at all.
Not for buying things day to day.
No. It's acting more like lubricant or just cash inside the crypto ecosystem, for trading, for collateral and DeFi.
Right. Decentralized finance. And bridging fiat, getting traditional money into crypto?
Exactly. Payments are actually tiny, only about 6% of demand.
Only 6%. Why so low?
Well, largely because of the friction. It's just a hassle, and it costs money to get regular currency into stablecoins and back out again. Think about the delays, the fees.
Go on ramps and off ramps, yeah. That makes sense. Plus, traditional payment systems are getting quicker.
Precisely. And crucially, they push back on the idea that things like China's e-CNY or even Alipay and WeChat Pay are good models for stablecoin growth.
How so? They seem successful.
They draw a clear line. Stablecoins are private digital liabilities. They don't yield anything. That's very different from a central bank digital currency like e-CNY or platform money like Alipay, which is tied to a specific company ecosystem. Different animals, basically.
Got it. Okay, so if JP Morgan's pouring a little cold water on the stablecoin hype, let's switch gears. What about the good old bond market?
Right. Their updated 2025 analysis shows the global bond supply-demand balance isn't deteriorating quite as much as they thought earlier.
Oh, interesting. Less of a gap.
Yeah. They now see the imbalance at about $0.4 trillion, down from a previous estimate of $7.6 trillion.
And what does that mean for yields, for returns?
It implies a bit less upward pressure. They estimate maybe a 20 basis point rise in global ag yields, which is, a broad measure of global bond performance, less of an increase than implied before.
Okay, 20 basis points. And what's driving this revised outlook? It's all about who's buying and selling, right?
Exactly. The demand-side dynamics are fascinating. You've got the G4 central banks, the Fed, ECB, BOJ, BOE, still doing their quantitative tightening, so they're selling or letting bonds mature. That's a drag on demand.
Okay, QT continues. But who's picking up the slack?
Well, retail investors are actually showing strong inflows into bond funds. But, and this is key, there's a definite tilt towards shorter-term bonds, especially since the U.S. election. A shorter-than-average duration impulse, as they call it.
Shorter duration focus from retail. And what about institutions?
That's the other side. G4 commercial banks have really stepped up. They're buying at an annualized pace of like $1.6 trillion in the first half of this year. Euro area banks are particularly active buyers.
$1.6 trillion pace. That's huge. But someone must be buying less.
Yes, pension funds and insurance companies. They're expected to dial back their bond buying in 2025, down by about $250 billion compared to their record buying in 2024.
Why the pullback there?
Partly because they don't need to rebalance away from equities as much, perhaps. Less pressure after a strong 2024.
Okay, so let's piece this together. Supply is pretty stable at $4.4 trillion globally. Central banks are selling, banks are buying big, retail is buying but focusing short term, and pension insurers are buying less. What's the net effect?
The net effect, especially with that retail preference for shorter duration, points towards steepening pressure on the curve.
Steepening pressure, meaning longer-term yields are likely to rise more or fall less than shorter-term yields.
That's the idea, yes.
So, first big question then. Given this more conservative outlook from JP Morgan on stablecoins, how should people recalibrate? What's the real utility beyond just crypto trading, and what else might fill that payments gap?
That's a great point. It suggests maybe the focus shifts. If stablecoins are primarily crypto infrastructure, perhaps other innovations, maybe even improve traditional rails or potentially CBDCs down the line, are where the real payment evolution happens. Investors should probably temper expectations for stablecoins disrupting everyday payments soon.
Okay, second thought. For bond investors, with all these different forces, retail going short, banks buying strongly, what are the actionable takeaways? How do you navigate this?
Well, it certainly argues for agility. That retail shorter duration impulse and the potential for curve steepening mean just blindly holding long-dated bonds might be riskier. Portfolio managers probably need to actively manage their duration exposure, maybe look for value in different parts of the curve, considering that steepening bias.
Right. And finally, if that yield curve does steepen, as JP Morgan suggests, what are the broader knock-on effects? For other assets, for general investor behavior, central banks are still a wild card too.
A steepening curve often signals expectations of better growth or maybe higher inflation ahead. That can be, well, mixed for equities, depending on why it's steepening. It definitely impacts borrowing costs. For you, the listener, it means reassessing risk and reward across asset classes. Where do you find yield? Where's the stability? It's a more dynamic picture than maybe a flat or inverted curve implies.
So that's our quick dive into JP Morgan's latest flows and liquidity, some really counter-narrative thoughts on stablecoins, and these nuanced shifts in bond demand pointing towards a steeper curve. Lots to chew on there. What really stands out to you from all this? It's worth reflecting on how these dynamics might influence your own thinking and investment decisions. Until next time, stay well informed.